Welcome back to IFRS is Easy. Today we'll be starting a journey into the world of derivatives. And as we all know it, there are a lot of intricacies in the topic. We'll be looking at it from the aspect of IFRS 9, that's financial instruments, and from the aspect of IS 32, that's presentation of financial instruments. And so we'll be starting today with what a derivative is in essence. And it will be taking us through a whole lot of journey, and I hope that we all learn something from this and from subsequent topics. So let's get started. A derivative is a financial instrument with all three of the following characteristics. Its value changes in response to a change in a variable that is not specific to the underlying item. It requires no initial investment. It is settled at a future date. But in fact, we are not starting with that. We are starting with where our emphasis is, which is financial instruments. So the question we want to be asking ourselves is, this financial instrument that we said derivatives are, what exactly does it refer to? And so that's how our topic will progress until we now get to that end point where we get to decide what derivatives are exactly. And we'll also be looking at the accounting for derivatives, both in terms of what IFRS 9 says derivatives are, and also in terms of when we use it as an hedging instrument. So please stay with us and we'll enjoy the journey together. It says here that a financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Now take note of the fact that the first thing is that it is a contract. Now before you can say you have a financial instrument, it has to be that what you have is a contract, and there has to be a contract document that is signed. It could be written, it could be implied, but the major thing is it is a contract. Now you will see why this is very important as we go along. Now it says here that it gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Now when we say it gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity, what we are saying in essence is that at any point in time when there is a financial asset somewhere, there has to be a financial liability or equity instrument somewhere else. Now if you remember our basic accounting, it says assets equals liabilities plus equity. Now the same thing applies here, because what we are looking at is financial assets. We are looking at it vis-a-vis financial liabilities and equity, but we'll be looking at what each of them means very, very soon. The underlying understanding here is that when you have a financial asset somewhere, then you have to have a financial liability or an equity instrument somewhere else. Now this is very important, it's very key to whatever we're discussing subsequently. Now let's take a very simple example. Now this lady in this picture here decided to buy a car on credit. Now the company that is selling the car will have to recognize an asset. An asset in the sense that there is a receivable to be expected from the lady as a result of buying that vehicle on a credit. But then, as the company is recognizing a financial asset, because the company will have to collect cash as a result of the contract that it has entered into with the lady. Now the lady also will be recognizing a financial liability because the lady has to pay cash back to the company. And so you see here that as the company is recognizing a financial asset as a result of that transaction or that contract, the lady is also recognizing a financial liability as a result of that same contract. So it's essential that when a financial asset is on one side of the transaction, the financial liability has to be on the other side of the transaction. Now same thing goes to that of equity. So in a situation whereby you decided to buy shares in a shipping company, now you will discover that as you are recognizing that you have made an investment in that company, which is an investment in equity, which is an asset to you, a financial asset to you, that company will also be recognizing an equity because you have bought the equity of the company. And so as there is a financial asset somewhere, there's an equity portion of it somewhere else. Now both have to be equal, because when I tell you that I have an asset in you, then that same asset has to be a liability at the other end. But this is not always the case, and so we'll look at it subsequently. Now if you go back to our definition, you will notice that there are three items that we have mentioned. We have mentioned that there's a financial asset, there's a financial liability, and there's an equity. So what that means is that financial instruments are made up of three items. You have a financial asset, you have a financial liability, and you have equity. So we'll be looking at each of them one after the other. We'll be explaining it with examples, and then before we get to our goal. Alright, so let's get it started. A financial asset, what is it? A financial asset is cash, equity instrument of another entity. The right to receive cash or another financial asset from another entity. Exchange financial assets or financial liabilities under favorable conditions. Now, when you look at the definition of financial asset, it says that the first thing is that it is cash. But don't forget that we have established that a financial instrument is any contract. Automatically, a financial asset must be generated as a result of a contract. And so it goes without saying that a financial asset has to be a contract. Okay, so a financial asset is cash, meaning that when you have cash, you have a financial asset. There are situations whereby a company has cash and has somebody that is an employee that works with that company that holds the cash. If you remember our undergraduate days, you have what we call a petty cash system, or where you have a cash till. Now that cash till, somebody holds it. Now there are even times when a company can decide to even outsource its cash activities. Now when that activity is being outsourced, you discover that company that is preparing its own financial statement would have actually recognized that there is a financial liability to so and so company. And so it goes without saying that at any point in time where you have a financial asset, there has to be either a financial liability somewhere else or equity. And so even if you have cash with you, there are two transactions to it, only that they might be invisible, but they're actually two transactions. There is a financial asset bit of it, and there is a financial liability bit of it. And so if you look at it that way, you can see that the financial asset is cash. Now, the financial asset can also be equity instrument of another entity. And if you remember the example we talked about with respect to investing in a shipping company, you have made an investment, you released cash out. That company would have recognized equity as a result of you investing in their shares. Now, the investment in the equity of that shipping company is a financial asset to you, while the shipping company would have recognized equity in its own books. So you see that those two sides of the transaction also goes in play. Now, another thing is that when you have the right to receive cash or another financial asset from another entity, then you still have a financial asset. Now, when you sell goods on credit, for manufacturing company that sells goods on credit and they recognize the trade receivable is a financial asset in their books. Now, the customer that bought those goods on credit would have recognized a financial liability. And so if you have the right to receive cash as a result of a particular transaction, then you have a financial asset. Now, you take note that everything that we have been saying has to do with cash, because the major crux of financial assets, financial liabilities, and equity is that cash must be involved. Okay. Now, another thing is that when you exchange a financial asset under favorable conditions, then you have a financial asset. And we'll look at this when we discuss derivatives in detail. Okay. Now, let's look at these examples and tell whether what we have is a financial asset or not. Company A statement of financial position has the following elements under the non-current assets and current assets. Which of the above are financial assets? So let's start with the first one, which is trade receivables. Is trade receivables a financial asset? Now let's look at it. We've mentioned it earlier that when you sell goods on credit to customer, you're expecting cash from that customer. And as a result of that, you have a financial asset. And so yes, trade receivable is a financial asset. Now, property, plant and equipment. When you buy property, plant and equipment, what you are expecting is the consumption of that property, plant and equipment. That is, you'll be using it, and that usage is as a result of depreciation that is being charged for the usage. And so we are not expecting cash actually, although the output of it, at the end of it all, where we use that PPE to make products, we can sell those products. But in the real essence of it, the PPE is just for consumption purpose, not for cash itself. And so because we are not expecting cash, PPE is not a financial asset. Now, for a prepaid expense is a situation whereby you make a payment for a particular service in advance of enjoying that service. And when you do that, what you're expecting is not cash. What you're expecting is a service. And so if you prepare for rent or you prepare for stationaries, what you're expecting is a stationery. What you're expecting is to make use of that rental service. You are not expecting cash. So you don't have a financial asset in this case. Staff loan. When you give loan to your staff, you expect them to pay back cash. And so staff loan meets the definition of a financial asset. I did a video recently on staff loan and staff advance. If you look at the description box below, you have a link to that. It explains how to do the computation of staff loan, amortization schedule for it, and so on and so forth. You can just check that out. Staff advance is not a financial asset. Why? Because you are giving cash to your staff to pay for some expenses, and because you are not expecting cash from them in return, you are expecting them to pay for some business expenses, and so that is not a financial asset. Accrued income is when you have earned an income but you are yet to receive cash for it. Now, for example, if you invest in mutual funds and probably you've already earned income as a result of your investment, but cash has not been paid into your bank account. Now, because you have earned that income, what you have is a financial asset, because what you're expecting as a result of that transaction is cash. Now, loans and advances to customers. This is popular with banks. When banks give loans and advances to their customers, what they expect in return is cash. And as a result of that, we have a financial asset. Now, investment in shares. We have said this oftentimes, that when you make an investment in equity, you're expecting cash, probably in form of dividends, or you're expecting cash as a result of this transaction. And so what you have is a financial asset. Now, don't get it twisted. Investment in equity is different from equity. Investment in equity is what we have here, which is investment in shares, which is a financial asset. But equity itself is that residual interest between asset and liability, where we say asset minus liabilities equals equity. Now, it's different from investment in shares or investment in equity. Investment in equity is a financial asset, which is one of the financial instruments. Equity is separate. So it's important for us to be able to identify the difference. Now, value-added tax receivable. When you see the word receivable, you expect that what you're expecting is cash. But remember that we mentioned that financial instrument is any contract. A value-added tax receivable does not arise as a result of a contract. Rather, it arises as a result of a statutory obligation. And as a result of that, it does not meet the definition of a financial asset. Some countries call it sales tax. So if you have a sales tax receivable, you do not have a financial asset. A financial liability is a contractual obligation to do what? To deliver cash. Don't forget, the previous one, which is a financial asset, is that you are expecting to receive cash. But the other side of it is that when someone is giving, another person is receiving, right? Good. So in this case, a financial liability is a contractual obligation to deliver cash or exchange financial assets or financial liabilities under unfavorable conditions. Okay, so let's look at examples as well. So it says, which of the above are financial liabilities? So let's take one after the other. Trade payables. When you buy goods on credit, you expect to pay cash to the vendor. As a result of that, your trade payable is a financial liability. When you have a trade payable, what you have is a financial liability. Why? Because the obligation is to deliver cash. Now, a contract liability. So a contract liability arises in a situation whereby what you have is more like an advance payment. So your customer has made payment to you for you to deliver goods to the customer, but you are yet to deliver those goods, but you have received cash. That cash is more like a deferred income. It is a contract liability because you have received cash, but you are yet to deliver the goods. Now, because what you want to deliver is goods, you are not delivering cash, then your contract liability is not a financial liability. Loans and borrowings happen severally with organizations that have need to borrow cash. And so when you borrow cash, you have to deliver that cash back. Now, because of that, what you have is a financial liability. Bonds issued. Now, when the government issues bonds, we have government bonds, we have corporate bonds. Now, when bonds are issued, you expect, bonds are almost like loans as well. That is, you receive cash in advance and you expect to pay back that cash. Only that the maturity date of bonds could be longer than that of a normal loans and borrowings. And so when you do that, you expect to deliver cash to whoever has given you cash as a result of you issuing bonds. And so you expect to deliver cash. Share capital. Share capital is what we explained under investment in equity and equity instrument. And so when there's an investment in equity, you expect that the other end of it will be equity. When there's an investment in equity, there's a financial asset. But the other end of it is equity. Now, equity is different from liability. IS 32 financial instrument explains this in detail, and I'll be touching on it in detail as well. We'll be explaining how to differentiate between what an equity is and what a liability is, because there sometimes might be a thin line between what we can call equity and what we can call liability. For example, deposit for shares. You might be wondering, will it be a liability or will it be an equity in the books of the company receiving it? You might be wondering, preference shares. Will it be an equity? Will it be a liability in the books of the person receiving it? We will be explaining this in detail in subsequent topics. And so stay tuned and let's enjoy the ride. So share capital in essence is not a financial liability. Rather, it is equity. Deferred tax liabilities. Deferred tax liabilities generally arise as a result of a statutory obligation. And as a result of that, we do not have a financial liability. A financial guarantee by a guarantor. So in a situation whereby you have guaranteed another entity that if this entity defaults, I will pay on that person's behalf. Now, because what you'll be paying is cash, you have a financial liability in your books. Equity is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. That is our basic accounting. Equity is assets minus liabilities. That is what this story just tells us. So let's look at this. Company's statement of financial position has the following elements. Which of the above are equity? So if you look at it, issued share capital. Issued share capital is basically the shares that a company has issued to the public for the public to buy into its equity. And so what you have is actually equity. I mean, your issued share capital represents your equity. Retained earnings is also part of equity because that is the amount that you have left that you decided not to share to your shareholders, as you decided to hold this and retain it in the company. And so it is also part of your equity. Your share premium as well. When you sell your shares at a premium, that is at an amount higher than its market value, you also have equity in that. Other reserves are as a result of other items that comes into play from your other comprehensive income that forms part of your reserves that are not shared or not distributed to your shareholders. It also forms part of your equity. Your authorized share capital will not be equity. Why? Because authorized share capital is just a nominal amount that is not actually added up in your books, in your financial statements. Your authorized share capital sometimes might be equal to your issued share capital, but it's not in all cases where your authorized share capital will be equal to your issued share capital. So that is why we do not take cognizance of authorized share capital as part of our books. Authorized share capital could be the total number of shares that you are permitted by your regulator to issue to the public, but that does not mean that that's what you have issued to the public. As a result of that, authorized share capital does not form part of your equity. What makes up your equity is your issued share capital. And so that is it about our understanding of financial assets, financial liabilities, and equity under financial instruments. And so, we mentioned earlier that derivative is the crux of our topic, and that is where we are going to. But we have not even started at all. We just want to take a bite into what derivatives is. And so let's get started. Our financial instruments can be split into two. We have the derivative part of our financial instrument, and we have the non-derivative part of our financial instrument. Now, when we say derivatives, for example, look at this picture we have here. You will see oranges here, and you will see juice that has been extracted out of those oranges. Now, a derivative is the extraction out of something because it derives its value from that thing. Our juice can have a higher price than the oranges themselves, but the juice derives that higher price from those oranges. And so derivatives derive their value from an underlying, which is the non-derivatives. So we'll be looking at how those are split very soon. Non-derivatives are normal transactions where we have a financial asset, a financial liability, and equity. But derivatives are as a result of those normal transactions. And let me quickly give a brief of what derivatives are. And in subsequent class, we will dive deep into it. Now, we say a derivative is a financial instrument with all three of the following characteristics. Number one, its value changes in response to a change in a variable that is not specific to the underlying item. That is, the oranges that we have gave rise to the juice that we have. But remember that the juice that we have is not necessarily just made up of oranges alone. It could be also made up of water, it could be made up of sugar, it could be made up of other items that have been added, even preservatives, as a result of us deriving that value from the oranges. And so its value changes in response to a change in a variable that is not specific to those oranges. But I'll be explaining this thing in detail in subsequent classes. Now, another thing is it requires no initial investment. Taking out juice from the oranges does not necessarily have to do with any expense, except probably the effort that comes in having to expunge those juice from the orange. But then you don't have to incur any cost as a result of it. I mean, you don't have to incur much cost or substantial cost as a result of it. Now, another thing is that it is settled at a future date. That is, at the point when you are extracting that orange, it is not immediately that you get that juice. It is not immediately like you get the end product, because it takes some time. You have to add some other things to it. You have to add preservatives, add sugar, add some other things. And it takes some while between when you actually have that oranges and when you actually have the final product. It is settled at a future date. Now, we'll look at this very, very soon. We will explain it in detail, but just not now, because we have some parts to take as well. Now, we mentioned earlier that we have three financial instruments. We have financial assets, we have financial liability, and we have equity. And we have stated that our non-derivatives are the normal assets, liabilities, and equity that we have. That is, those ones, nothing has been extracted from it. It is crude. It is not refined oil. It is crude. Good. And so when I have a trade receivable, my trade receivable is my financial asset. It is non-derivative. I have not added anything to it. I have not extracted anything from it at all. If I give loan to my customers and I charge them a fixed interest, I have not added anything to it. I have not extracted anything from it at all. It is what it is, which is my financial liability. Now, if an investment comes into my company in form of shares, which is equity, nothing has been added to it, nothing has been structured from it at all. So it is a non-derivative. So any financial instrument that follows the normal form of transaction is a non-derivative financial instrument. And those non-derivative financial instruments can be a non-derivative financial asset like your trade receivables, a non-derivative financial liabilities like your loans and borrowings, and equity is always fixed. We will look at this in subsequent classes. It is always a non-derivative. You can never have an equity that is a derivative financial instrument. your equity will always be non-derivative because you expect it to be a fixed amount of shares that you have. If it becomes derivative, automatically it's no longer equity. It will become a financial liability most likely. But we'll look at that in subsequent classes. But the major thing we want to establish today is that your normal financial instruments are non-derivative financial instruments. It is when anything external to it is added to it that we now have something else that is called a derivative financial instrument. And so because we can have a non-derivative financial asset, we can also have a derivative financial asset, which we'll look at subsequently. We have derivative financial liabilities as well, but our equity will always be non-derivative. There are two items under non-derivative financial assets. The non-derivative financial asset could either be debt or could either be investment in equity. We mentioned earlier that investment in equity is a financial asset. Now, any other thing that is not an investment in equity that is still a financial asset is called debt. So when you have a trade receivable, your trade receivable is a debt instrument, but it is still a financial asset. When you have loans and advances given out to customers, it is a debt instrument, but it is still a financial asset. When you have staff loan given to your customers, it is a debt instrument, but it is still a financial asset. So it is important to take cognizance of this fact, that the fact that something is a debt does not mean it is a liability. And that is one of the things that actually gets people confused in IFRS 9 financial instrument. You say, this thing is too difficult, because why will you tell me that I have a debt instrument and it's an asset in my books? Now, IFRS calls it debt instrument, but debt instruments can either be a financial asset or a financial liability, depending on its nature, depending on what it represents. So if you have a trade receivable, it's a debt instrument. If you have loans and advances given to customers, it's a debt instrument. If you have staff loan, it's a debt instrument, but they are still financial assets. And that's why you say that a financial asset that is a non-derivative, that is a normal financial asset, is divided into two. It could either be an investment in equity. That's when we mentioned that we bought shares in a shipping company. It is an investment in equity, or a debt instrument. So every other financial asset that we have listed earlier are debt instruments that are financial assets and are non-derivatives. Now, the derivatives ones, we'll talk about them later. That's where we talk about forward, options, swaps, and futures. Now, same goes for financial liabilities. Now, a financial liability, what it has is just debt alone. Because, when you say investment in equity, that's automatically a financial asset. So, for financial liabilities, the normal ones are non-derivatives and they are debt instruments. This is where you have bonds issued, where you have loans and borrowings. But loans and borrowings in this case now is a liability. You also have loans and advances to customers, which is a financial asset. So it is important to be able to identify the differences between this. That when you are expecting to receive cash, then you have a financial asset. But when you are expecting to deliver cash, then you have a financial liability. So for financial liability, the normal financial liability that we all know, they are non-derivatives and they are debt instruments. Just the way we have for financial asset. Only that financial asset, we have debt instruments for financial asset, and we also have investment in equity. But for financial liabilities, it is just debt instruments, and they can also be derivatives. And as we mentioned, for equity are always non-derivatives. Anything that makes equity a derivative automatically transfers it back to what? You guessed right, a financial liability. And so equity does not have anything to do with derivatives. So by the time we get to derivatives, you can never hear me say, this equity is a derivative. No. All right, so quickly, let's look at this. A derivative can be any of the below financial instruments except what? You know the answer to that. All right, so can you solve this? Company A statement of financial position has the following elements. Identify the financial assets, the financial liabilities, and those that are non-financial instruments. If you have enjoyed today's class, because we're having subsequent classes that has to do with financial instruments, we'll be talking about IFRS 9, we'll be talking about IAS 32, and by explaining in detail what derivatives are, what hedging instruments are, and how to account for them. If you have enjoyed this, please give a like, comment, and I'll be back for more. please subscribe. Thank you for watching.